Okay, hi everyone. This is going to be the first lecture on Chapter 8. We're going to be looking at international tax. So when we're talking about international tax, we're really looking at how do we tax a taxpayer when they have activity, income, for example, in two or more countries. And in this chapter specifically, what we're really going to be looking at is international tax, how the U.S. treats it. Every country has their own rules, but we're going to be focusing on international U.S. tax law. Now, in this regard, right, the first way it cuts that we would have to distinguish is, are we talking about inbound taxation or outbound taxation? So you could have an inbound client or an outbound client. What does that mean? Inbound taxation refers to how the U.S. taxes a non-U.S. person that has U.S. income. So, for example, say we have a French citizen who has a U.S. rental property that they rent out, right? How does the United States tax that situation? It's an inbound situation. A person from another country has a connection and enters into the U.S. and has tax consequences. In distinction, right, we have outbound taxation. So this is how the U.S. taxes U.S. persons, individuals or entities, on their overseas activities. So for example, if you had a United States MNC, like Apple or something like that, and they have income from a foreign operations in France, for example, how would we treat that? So outbound taxation refers to a U.S. taxpayer. How do we treat and tax their income from activities outbound the United States? So this chapter specifically, right, we're going to be focusing on outbound taxation of U.S. MNCs and individuals, right? So we're really going to be focusing on this. Inbound could be a separate whole lecture, but for right now, let's focus on outbound. So with any taxpayer, right, the goal is going to be to minimize taxes. So if you have a MNC, right, then your goal is going to be minimizing your overall worldwide tax liability. To do this, right, you're going to have to understand your country as well as other countries' tax laws. Now, there's three questions you have to ask or consider here. If let's just say you're a US-based MNC and we have excess money, right, and we're looking to grow our operations. First question would be, where do we want to invest, right? What country makes the most sense to take this money we're sitting on and go build a factory and grow, right? What country should we invest in? So in that analysis, right, we'd have to consider our after-tax profits as well as our cash flow. So what would country A produce? What would country B produce with regard to taxation and cash flows? Likewise, we have to consider what legal form of operation would we want to pursue. So should we create a foreign branch, right? In which case it would be an extension of our home country business. Or instead, should we create a foreign sub, like actually create a new separate legal entity in that foreign country? And then third, what method of financing, right? Suppose that we were trying to finance our growth in a foreign country. Should we, conduct and finance our foreign operations through equity, right, where we'd have to pay dividends, like issue stock and pay dividends? Or is it better to do this through debt, right? Borrow money where we'd have to pay interest payments. In this analysis, right, why this is important, there's something called a withholding tax that countries could impose that would affect this calculation. So with regard to corporate income taxes, most countries provide a direct national tax on business income, somewhere between 15 and 35%. There can also be additional local taxes. So it's kind of like in the United States, right? You pay federal income tax, but then you also pay state income tax. So you have to be aware when you're looking at the overall tax rate and be cognizant of the effective tax rate, all of the taxes you're paying. And as I have here, right, some countries modify the tax rate based on the type of activity. So, for example, in France, you may normally pay a 33% tax rate, but they would reduce this to 15% if the income was related to intellectual property rights. So it's activity specific. Now, MNCs, right, they're going to engage in capital budgeting, and any kind of project they take on in a foreign country, like building a plant, doing this, doing that, they're going to compare basically the present value of those future cash flows associated with that project with what it's going to cost us to do this. Basically, does this make sense, right? Capital budgeting. Are we going to make a profit from doing A, B, and C in a foreign country? When we consider and we conduct capital budgeting, taxes are going to play a part of that role. Now, one of the things I have here, right, tax rates alone are not the sole indicator of tax liability. So, in other words, a myopic view would be basically saying, hey, what country has the lowest tax rate? That's a really important criterion, but it's not going to be the sole criterion. In other words, there's also deductions and credits. They can get you to a lower tax rate. So again, you have to look at the overall picture here. The lowest tax rate in and of itself isn't going to control, and we also have to be aware of the different levels of taxation that a country imposes. So recent history, right, in the last 20, 30 years, and even last 5 years for the US, right, many countries have been reducing the corporate tax rate to attract outside businesses. For example, Spain in 2016, they went from a 28 to a 25% tax rate. And in 2017, the US went from a 35 to 21%. That's one way if you're a country and you want to attract foreign businesses to come and invest, lower the tax rate. Another thing you can do as a country to encourage outside investors to come in and build and grow in your country would be to offer a tax holiday, right? So for example, if you invest a certain amount of money in our country, or you perform a certain activity, we're going to give you really reduced taxes or no taxes for a designated period of time. So it's kind of like when states, for example, when Amazon was building a new headquarters, right? They had a kind of headquarters 2 that they were building outside of their main office. States, in that case, to encourage Amazon to come because it would help grow their economy, we're giving them tax holidays, right? Like if you come and build here, you won't have to pay property tax for 5 years, 10 years. A similar analysis could be made at like the macro level, the country as a whole, right? If you offered as a country kind of a holiday from federal income tax or other federal taxes, that could encourage individuals and businesses from other countries to invest here. So countries with unusually low corporate income tax rates, or none at all, right? We're talking about how to encourage external investors. Some countries may say we're going to have no income tax. In these situations, these countries are known as tax havens. Common culprits here are the Bahamas. There's other areas, but you'll often hear news stories about the Bahamas or other items here. So how would this work, right? So imagine we have a Brazilian company, right? They have products that they're going to sell for that it's going to generate $100 of income, and they're going to sell it to Mexico, right? So Brazil has a corporate tax rate of 34%. So what's going on is we have a Brazil company that sells to Mexico. It's going to generate $100 of profits, and there's going to be a 34% tax rate in Brazil. So option 1 here is just follow this configuration. Brazil sells to Mexico, has a $100 profit, 34% tax rate, 34 tax liability, right? Overall 34 tax liability. In distinction, right? Let's say that we're this Brazilian company and we open up a foreign sub, right? A new legal entity in the Bahamas. Of that $100 profit, right? Let's say that what's going on here is we sell the goods to the Bahamas subsidiaries at a $10 profit, basically, in this case, 34% tax rate. So, transaction one is from Brazil to the Bahamas with $10 profit, so $340 tax liability. And then of the remaining $90 profit, we generate that in the Bahamas, right? We have the Bahamas, then sell to Mexico, where there's a 0% tax rate. So in this case, right, the overall tax liability is going to be $3.40. So if you're, the Brazilian company, right, all day, every day, if the goal is to lower taxes, you're going to pick $3 that you have to pay instead of 34. All you have to do in this case is open up and create a foreign sub in the Bahamas. Transaction one, Brazil to Bahamas. Transaction, pay a little bit of tax there. Transaction two, Bahamas to Mexico, no tax there. So this is a commonly leveraged technique. Ireland and the Netherlands are very popular countries to create these foreign subs in for how you would effectuate this. Now, the next idea here that we have to consider, right, this is just a general lecture. It's just telling you the different dynamics that are in play in international tax. There's not a one-size-fits-all answer for everybody. It's a facts and circumstances, taxpayer-specific question. But variables in that consideration, one of them would be withholding tax. So if you're investing in a foreign country, for example, you buy foreign stocks and bonds, and you as an investor would receive payment, in that case, the foreign country in which the business is located often applies an automatic withholding tax to ensure collections on taxes. So let's say, for example, here, right, we have a French citizen who invests in a U.S. corporation. The U.S. corporation declares a $100 dividend. What will happen is the United States will say, hey, anytime we have this setup, right, where we have a foreign investor investing in one of our businesses, when you, a U.S.-based business, make a payment to them, you have to apply a withholding tax automatically. And we're going to, in this case, apply a 30% withholding tax. So if you're the French person here, what happens is, yeah, the U.S. corporation declares a $100 dividend. In that case, the U.S. corporation is going to automatically, off the top, take 30% of that. It's kind of like withholding on your paycheck almost. That's why they call it a withholding tax. Pay it to the government and then send you, the French investor, the remaining $70 or 70% of it, right? And the reason they do this, these withholding taxes, you can imagine, right? Maybe you're this French investor, whether it's intentional or innocuous, there are situations where you may not pay the tax to the U.S. government, right? You may say, I didn't know I had to do this, or it was too complicated. So what the U.S. government does is they kind of tackle this on the front end, and they say, we're going to withhold the tax up front. Now, withholding taxes apply at the individual level, as well as between parent and foreign sub. And the type of payments they apply to are things like interest, dividends, royalties. And depending on the type of payment, like which one of those is being paid, as well as the configuration, is this parent sub or is this individual, there can be different withholding rates. So as I have here, right, interest income will usually be taxed at a lower withholding rate than other items. So the combination of this, right, a low tax rate, a low withholding rate on interest income, as well as if this was from like foreign sub to US-based parent, for example, the idea of them being able to get a deduction for interest expense, that can overall make debt a preferred option over equity. And in this case, it's known as like thin capitalization. So debt over equity. The overall benefits of it, the interest expense, as well as the lower tax rate, would lend itself to this. Now, this is just showing you, some examples here. So we have, the corporate income tax rate that different countries impose. And this, was based off of 2017. So since then, things have changed. This is showing some countries that are potentially tax havens where they have really low tax rates. And these guys right here, this withholding tax rate, this is showing you how countries impose withholding tax on specific types of income. So you can look at that there to see. So for example, if we look at the United States, dividends have a 30% withholding tax, 30 and 30 for interest and royalties. But that's not always the case, right? They can tax it at different amounts. The next thing we have to be cognizant of here is a VAT, right? A value-added tax. Now, this is probably a foreign concept for many of you guys, like literally a foreign concept, because we generally don't have a VAT in the United States. However, the rest of the world, especially in Europe, does impose a VAT. So what's the idea here with a VAT, right? Many countries generate significant income through a VAT. These are used instead of a sales tax and are generally incorporated into the price of the product. So for example, the standard VAT in the EU ranges from 17 to 27%. Note that the USA does not have a VAT, but implies sales tax instead. So this is the big idea with a VAT right here, right? It's basically a tax that's applied at each stage of production. So say we have a Swedish company, they sell a product to a Swedish wholesaler for 100,000. They have to pay the VAT at that level, 25 grand, right? This company pays 25 grand. Then you have the wholesaler who sells it to a customer for 160. They have to pay $15,000 in VAT, a value-added tax. So that's the idea with it, is it kind of looks at each stage of production, how it gets all the way from when it's made all the way to when it's sold. And each of those stages, each party is going to have to pay a value-added tax. Versus in distinction in the US, right, we're generally not going to have that value-added tax as a freestanding tax, but instead what we do is when it's ultimately sold between parties, we will have sales tax in that case. Now, as I have here, right, these are types of indirect taxes, like sales tax, VAT, payroll taxes. When you're looking at investing in a country, right, yeah, you may really have low income taxes there, but there could be really high value-added taxes. So you have to consider all of these dynamics in how you're going to invest in a particular country. Next thing here we have to be aware of when we're talking about international tax is double taxation, right? This occurs when two countries assert the right to tax the same income. Now, as just like a simple example, right? Let's say the U.S., right? They tax worldwide income. You go and you make money overseas, right? Let's say you make it in Germany. Germany's going, and let's say you make $100, right? Germany is going to tax that income, and then the U.S. is going to tax that income. That's two parties taxing the same $100. So that's called double taxation. There's a number of different ways we can resolve it or work around it, but that's the problem, right? Now, if we're talking about foreign source income, FSI, namely income earned in another country, so you're the U.S. person and you make income in Germany, the FSI there would be German income. There's two approaches to it for FSI. You have the worldwide approach, which is generally just the United States. They say, hey, all income, wherever it's derived in the world of a resident or a company is taxed in our country, regardless of where it's earned. So we're going to tax all of your income, even if you make it outside of the United States. Versus in distinction, a territorial approach, if a country took this, they would basically say, hey, we're only taxing income that's earned within the borders of our country. So two scenarios here. One worldwide approach, U.S. citizen makes income in Germany. In that case, the U.S. will tax it. It's outside its geographic borders. In distinction, if we had a territorial approach instead, say that we had a German citizen who made U.S. income, and say Germany adopted a territorial system, in that case, Germany wouldn't tax the income because the income was made outside the borders of its country. So it's kind of like GDP versus GNP, where you just look at like literally what is made in the country, the income. That's called a territorial approach. Now, some countries can have a hybrid approach where basically depending on the type of foreign source income, they will tax it or they won't tax it. So for example, a home country may tax foreign branch income, but not income from a foreign sub. This idea where they're not going to tax a particular type of foreign income is called a participation exemption. And many of the OECD countries have adopted it. So kind of two ends of the spectrum, worldwide versus territorial. Somewhere in between is called a hybrid approach. And it says, depending on the type of foreign income, we will or we won't tax it. Now, prior to 2018, the U.S. adopted a worldwide taxation system with regard to corporate income taxes. Now, one of the ways that they kind of, had a hybrid approach to this is they said, hey, you're a U.S. corporation. If you have foreign branch income, you just extend your operations into the foreign country, that's going to be taxed immediately. Whereas in distinction, if you open up a foreign sub, we are going to only tax the income from that when you repatriate it back to the United States. So this whole setup, right, the old setup, really encouraged companies to create foreign subs, make money over there, and then just sit on the money, right? Because if they bring it back to the U.S., they repatriate it. In that case, they have to pay tax on it. So what the TCJA did is they really made the U.S. from a participation exemption to a territorial system. That's what they did. So beginning in 2018, dividends from a foreign corporation are generally no longer going to be subject to the U.S. corporate income tax. That is to say, we're going to have 100% DRD. And then income from foreign branches continues to be taxed when earned. What they also did, and we'll talk about it, is they had like a one-time transition tax that brought back a lot of the unrepatriated income, but we will talk about that later in the PowerPoint. So basically just be aware, under the old dynamics, they had, for corporations, you could only pay tax on the income when you repatriate it. In part, they have kept that, but they have tried to address a lot of it under the TCJA. We'll talk about that in the last part of the lecture with things like GILTI and transition tax. Now, in order to kind of claim stake or apply a tax to an individual or a business, a country kind of has to have jurisdiction, right? You can't just randomly tax anybody or anything. You have to have jurisdiction. Now, there's many bases that can give rise to jurisdiction. The first one being the source of income. So countries can assert tax authority over income earned in that country, the source of the income, regardless of the citizenship or residence. So the U.S. may tax a French shareholder who receives dividend from a U.S. company. The source of that income was in the U.S., therefore we're going to have tax jurisdiction over it. Next is citizenship. Citizens can be taxed based on their country of citizenship, regardless of where they reside or the source of income. So the U.S. uses this, right? U.S. citizens are taxed on worldwide income. Finally, here we have residents, right? Residents are taxed on where they reside, regardless of their citizenship or where the income is earned. So, for example, a French citizen who would become a U.S. resident and they earn passive income from England, the U.S. can tax this because they're saying we're using residency as a basis. So what they really look at is a combination of like where the income is earned or where you're located, whether that's on a permanent or a non-permanent basis. In those cases, that's the basis we use to tax you, to apply and basically invoke tax jurisdiction. Now, with this setup, right, this can give rise to double taxation if countries are using different bases, right? Maybe us in the United States are using a citizenship basis to tax you, but then you make money in Germany and they're taxing you based off of the source of income because it was sourced to Germany. These are like why double taxation comes into fruition here, why it happens. So regarding corporations and foreign subs, right? So you have a U.S. corporation who opens a foreign sub in England, for example. The foreign sub country taxes the income based on the source, whereas the parent company would tax the income based on residence. Just looked at that, right? That gives rise to double taxation. To avoid this, one country basically has to bite the bullet and give up some of the tax dollars. And the norm in international tax is generally going to be that source takes precedence over jurisdiction. Source takes precedence over residence. So thus, the parent company in this case is going to have the burden to get rid of or eliminate the double taxation. So again, what's going on here? U.S. company opens up foreign subsidiary in England. There's $100 of income in the foreign sub. The U.S. says we're taxing that based on residence, for example. You're a company, you reside in the U.S., we're going to tax all of your income. England taxes it based on source. This income was made in England. As a general rule, source is going to trump residence. Accordingly, the U.S., who has residence as their basis, we now have the burden to eliminate the double taxation. A few ways we can do this, right? We can have a foreign income exemption, a deduction for foreign taxes paid, or we can have a foreign tax credit. We'll talk about some of those later on in the chapter here, but let's move to the next point with tax treaties, right? Again, we're just talking high-level overview of the different items that come into rise with international taxation. So a tax treaty is an agreement between two countries regarding how the companies and individuals from one country will be taxed when earning income in the other country. Basically, what we do with a tax treaty in many situations is, hey, we recognize that there could be double taxation here. And to kind of prevent this from happening or to address it up front, right, to encourage international trade and reduce all the tax headaches, we will enter into a tax treaty. Maybe the U.S. enters into a tax treaty with Canada, for example. We do this, like I said, to encourage trade. Encourage trade by virtue of reducing or mitigating double taxation, as well as looking at things like withholding rates. So with regard to tax treaties, there's a variety of models out there, like kind of starting points that you can pick from. There's a model OECD treaty, which is often used. There's a UN model tax treaty. Now, under the model OECD, how they do it is they're going to have business profits be taxed by a treaty party country only if they're attributed to a permanent establishment in that country. A permanent establishment includes an office, branch, factory, or construction site. The model OECD country also provides for a reduction in withholding tax. So we'll see, right? The idea with this is, first off, it's a model treaty. So the OECD, this is like the big collection of countries and groups that are looking at international trade. They have provided a model treaty that says, hey, here's a model. You can use all of this or some of it. To the extent you want to enact it, you can do it. But here's a model you can work from. One of the things in this model that we're trying to do here is not have countries pull the Bahamas thing, right? Where we saw the Bahamas. To the extent we want you to be involved with other countries, we want you to actually have a presence in those countries, right? So the thing with like Brazil, the Bahamas, and Mexico, if you want to be in the Bahamas, that's great, but let's have a more permanent establishment there. instead of just kind of playing with a on paper company that doesn't actually exist. That's one of their goals, right? And another one of their goals is to lower the withholding rates. Because the idea here isn't to stop outside worldwide investment, right? That's not necessarily a bad thing. For companies to grow and get bigger, you oftentimes have to look outside your own country. The problem rather becomes when you do that, when you start leveraging these tax rules that basically make you pay little or no tax. That's what we care about. And really, what's happening here are a lot of the developed countries like the US, those in the EU, a few kind of, as it were, bad guy countries. Now, they're not bad guys per se, but things like the Netherlands and the Bahamas, they're basically ruining it for everybody, for all of these developed countries, because they have really favorable laws that are being taken advantage of. And if you are the Bahamas or something, right, maybe you aren't a giant country, or maybe you're economically not as strong as another country, so this is the best card you can play. So you can't really fault these countries, but the idea with it is a few countries that have very generous, favorable tax laws are creating a lot of headaches for the rest of the countries in the world. So the U.S. also has a model tax treaty that exempts interest and royalties from withholding tax. It establishes a minimum or a maximum 15% withholding rate on dividends. Again, they want countries to come and work with us, right? We have a model tax treaty available that you can look at, that we can start from. So as I have here, right, in deciding where to conduct business, a U.S. multinational corporation would need to be cognizant of treaty implications. So for example, right, assume you have a $100 dividend paid from foreign sub to U.S. parent, right? If we had a Japanese foreign sub, there would be a 5% withholding tax rate under the treaty between the U.S. and Japanese, meaning there would be a $95 take-home amount. If, however, we base this foreign sub in Taiwan, right, we don't have a treaty with that country, so there would be under Taiwanese law, 20% withholding rate. So in other words, we take home $80. So again, this is just one of many considerations, right, the withholding rate. But when you're looking at other countries, you have to be aware of, okay, here's how in general the country taxes it, but how does the country also tax it in light of our country having a tax treaty with that other country? So this is just showing, the U.S. tax treaty, some withholding rates underneath it. You can look at that. So the next idea here is that we got to be aware of is treaty shopping, right? So what is the idea with this? Treaty shopping is the process in which a resident of country A uses a corporation in country B to receive the benefit of country B's tax treaty with country C. Okay, so we have A, B, and C involved, and there's a treaty that we're going to be leveraging to take advantage of. This is called treaty shopping. So let's assume that we have a Brazilian taxpayer, country A, that has investments in a U.S. company, country B, and let's say that the U.S. has no treaty with Brazil, and thus if there were a dividend payment to Brazil, there would be a 30% tax rate. So thus the taxpayer only receives 70% of the dividend, right? That would be just a normal setup. A invests in B, right? We would only get 70% of the payment. Now let's instead say we're going to do some treaty shopping, right? And let's say that we as country A, the Brazil, are going to form a corporation in the Netherlands, right? Country C in this case. So dividends from the U.S. company to the Netherlands would receive a 10% withholding rate under the U.S. treaty between those two countries. Likewise, there'd be no income tax in the Netherlands on the earnings and no withholding tax on the distributions back to Brazil. So in this case, right, if we did option B, down here, we'd receive 90% of the dividends. In other words, you go to a 10% rate versus a 30% rate up here. So you can see this is the idea of treaty shopping, leveraging a treaty down here to pay less tax. So to combat these practices, right, they're not entire, like there will always be a chicken and egg syndrome here. There's a situation here. There's not a clear-cut answer that's going to totally resolve this. But to combat this, to at least deter it, the U.S. has created limitation of benefit provisions in treaties that stipulate favorable withholding rates are only available to businesses in foreign countries if they are more than 50% owned by the third party. So they, again, just like the OECD had that permanent establishment, if you're going to take advantage of this, then you better at least have some skin in the game and really own the foreign sub. This better not be something that's just like on paper where you own 1% of it. So MNC profit shifting, basically like in the situation we just looked at with Brazil, Netherlands, and the US, or the prior example with Brazil and Mexico, right? Shifting the profit from a basically high tax to a low tax jurisdiction using tax havens when there's really no economic activity taking place. This is known as base erosion and profit shifting. In other words, let's say we're Brazil right here, right? And in this case, right, we have the US and we have the Netherlands in this case. We can see, right, that we're getting a lot more of the dividend and we're paying less tax. So what countries are complaining about, they're basically saying, hey, our base, our country base, all of the income is being shifted out to other countries through use of these tax treaties or tax laws. This is really eroding, tax that would have been collected in our country and shifting the profit over to lower income countries, right? So this is known as BEPS, right? Base erosion and profit shifting. It's basically BEPS, the idea of tax treaties and tax laws being taken advantage of. Now countries, in light of these being taken advantage of, are missing out on income or taxes they otherwise would have had. So this is a global problem, right? Like I said, it's everywhere over the world. The idea here, the location of profits are mismatched with the location of the underlying economic activity. So countries are losing revenues. So again, this is just kind of doing this stuff on paper, but not really actually having a true foreign sub that's growing and operating in the foreign country, right? So it's just kind of paper profits only. Basically, the OECD has looked at this. They've created a BEPS plan that's going to try to close the gap, basically on tax laws that allow MNCs to artificially but legally reduce their taxes. So what is happening here? Like I said, a few countries are causing a bunch of headaches for all of the other countries in the world because of their low tax rates or their tax treaties. What has now happened is the OECD, which is in part, like a big part of it, are the countries who are losing out on the money, right? They're being affected through base erosion. The only way you really combat this, right, is you kind of have to get everybody to buy in and have similar provisions and laws and regulations. If you have one little loophole, it's going to be taken advantage of. So that's the idea with the OECD to combat this, right? They're trying to get buy-in from all of the other countries who are part of the OECD. So with that, we're going to finish the first part of the lecture.